welcome to the Immaterial Podcast, where we explore the front page and the footnotes to discuss accounting, the law, white-collar crime, and everything in between. I'm your host, Chris Ekimoff, and today we're back with an Analytical Procedures episode focused on recent developments and current events in the legal, accounting, and finance space, joined by my good friend, Tiffany Rowe. Tiffany is counsel at Parker Poe in Washington, D.C., focused on advising her clients on industry-specific compliance and federal regulatory requirements. She has extensive experience helping clients navigate enforcement actions and litigation pursued by the SEC, PCAOB, and FINRA. Tiffany earned her law degree from Catholic University of America and her undergraduate degree from GW University in Washington. Tiffany, welcome to the Immaterial Podcast.
Thanks, Chris. I'm really glad to join you today.
Well, today we're tackling a topic that is of interest to you and me. Before we started recording, we were just discussing 10Ks and Qs. This topic is really moved from a policy debate to potential rulemaking relatively quickly. That idea being whether the SEC should allow public companies to move from a mandatory quarterly financial reporting regime that we're under now to a semi-annual reporting model. But before we get into the details, let's level set, Tiffany. This idea has been around for years, but all of a sudden feels a lot more real. What's happened?
Well, first I want to say, personally, I have my own reasons for thinking that semi-annual reporting isn't a bad idea because there would be a lot less for you and I to read.
Oh, no.
But that being said, I think this is really growing out of Commissioner Paul Atkins being back at the SEC, and this time, at the helm. And he's really kind of following President Trump's lead, which is focused on, raising capital, increasing the number of IPOs, bringing more investment into the United States. So I think really what the focus here is to kind of take down costs, narrow information that's given to investors so that it's easier to read, and just just make things a little bit more streamlined for public companies.
Yeah, and I guess one of the things that, you don't read in the headlines is this is not doing away with quarterly reporting. The idea is that mandatory filing requirement of every 3-month basis will be removed. You could still report quarterly if you chose to.
Right, and I think that a lot of companies probably will, but you're right. It's not taking away the opportunity. It's just taking away the mandatory part of it.
Right. So let's talk about the benefits, right? Besides you and I having less public filings to peruse on behalf of our clients or from a business development perspective, why are some in the industry in favor of making this change from a mandatory quarterly requirement to only requiring everything semi-annually?
There have been a lot of different discussions about how this can help investors in regards to how these companies grow and how it would affect stock price. So one of the arguments is that this would shift away from this 3-month focus where companies are really looking to provide the next growing numbers and look further into the future and make more investment in things like research and development. Again, like I mentioned before, it's trying to bring down the cost that these companies have to put out for their quarterly reports. That's going to benefit small companies more than big ones. But then, also query how much of a savings there really is when the Qs just aren't as involved as the Ks are. And then again, the public company attractiveness, they're looking at it because they see an opportunity again to take down costs and to make public markets more appealing. But the SEC is doing so much in this area of trying to, drive innovation and drive investment that I really think that this is something that should be kind of on the back burner.
Yeah, and you hit on two great points there I want to reiterate. The first is how this would impact businesses of different sizes, right? I can imagine the Fortune 10 are going to view a change from quarterly to semi-annual reporting a lot different than Fortune 451 to 500, and then obviously everyone else below that. It's interesting. I was just catching up with a good friend of mine who's an internal audit leader at a publicly traded company yesterday, and he was asking about what this topic was and how you and I were going to talk about it. And he made the comment at a smaller publicly traded business, this is a big dollar and level of effort activity on a quarterly basis. So maybe from an audit fees perspective, right, or a preparation perspective, that dollar expense might not be significant or material relative to the company, but the level of effort to have this drumbeat happening on a quarterly basis is significant for those who maybe are a financial reporting outfit of one or two people or need to consult outside of that. And then the second, too, I think you hit on something we didn't talk about up front, is the trend generally for IPOs in the market over, I don't know, say the last 10 years. A number of publicly traded companies is lower than I think it's been within the relevant range of history, right? Say from
Right.
the mid-'80s onwards to now. And then also the number of IPOs that are happening on an annual basis are lower. And there are a variety of reasons why people argue that is the case or not. If that's good or bad, we'll leave value judgments to you, listeners and viewers out there. But one of the things that people talk about is the administrative cost of going public and the ongoing need to provide quarterly updates, to have those figures and facts audited and reviewed ahead of time, as being one of those reasons why there's less out there. But I think an interesting point for those of us who live and work in the United States and believe that we're the center of the universe, again, value judgment about that, I'll leave to you all. This idea of only requiring semi-annual reporting is well accepted outside the U.S.
It is, and we've seen it in the UK and we've seen it in Europe. They did away with it. They found that, again, most companies were still, reporting even though they didn't have to. I mean, the contents of those reports probably changed because they weren't, you didn't have the same expectations as are, specifically outlined for a mandatory Q. But a lot, I think it was in Europe that they actually rolled it back and they went back to mandatory reporting. I got to say, the one thing that I think about, and I think this applies to both large and small companies, although the cost effect is going to be different. It is very clear that there is a cost associated with actually preparing and publishing your report. But there's so much behind that, right? Like you need to already have all of your compliance policies and procedures in place.
Right.
You need to have all of that lined up, and you need to continue to follow your procedures to make sure that everything's ticking along. So in one regard, it almost makes me think, if you already have all of these functions in place, like I said before, how much of a cost savings is there really? Now, again, small companies, completely different than it is for, a Johnson & Johnson or an Apple. But if you really want to keep things on track, right, with your compliance policies and procedures, I think that's really the bare minimum if you decide not to report on a quarterly basis.
Right, and to hone in on that as well, it's kind of like, are we really just kicking the can down the road and we have to do 2 quarters worth of reporting in a 4-week period leading up to the end of our semi-annual reporting period versus having each individual 3-month period kind of level of effort, and obviously there hopefully is some synergies and overlap there if this change goes in to make that happen. So Tiffany, it sounds like this is a great idea. Everybody outside of us in the world already does it. What's the argument against making this change?
So I think there are a couple main points, right? I think first of all, there's this idea of information asymmetry, where you have people within the company who know this information, and not that that's necessarily going to lead to something like insider trading, but it is going to provide an insight into where things stand and where things are going from a financial perspective or even from a qualitative perspective. So I think that's one thing. It's kind of leaving investors in the dark a little bit. Relatedly, this is really about giving investors more confidence in the information that they're getting from companies. So, you have a standardized data set in a mandatory queue that comes out, and you have the same information that is submitted by every public company. It's easier to consider it, first of all, for an individual company quarter by quarter, but then also to kind of look at, compare one company to another. And then finally, there's the question of market liquidity and coverage. And, there are a lot of individuals who don't follow SEC filings day to day.
Yep.
So even though you have the requirement that anything, like any material event, be filed within 4 days on an 8K, there's always the question of, well, when do you decide that it's material?
Right.
And then the 4 days run from when you actually make that decision. And I've seen companies, I look at something that I think is truly material, and it's not reported until the next Q or even until the next 10K. So, it gives me some pause there to really rely just on voluntary or, the 8K reporting.
Yeah, I think of this too. These rules were structured and created in, with the Securities and Exchange Acts of 33 and 34 as a bedrock, and obviously there have been many updates since then. But the way in which the investing public and institutional investors interacted with companies from an information perspective were obviously very different in 1936 than they are here in 2026. And also, if you're a little bit cynical like me, you may watch the markets and individual stocks and know that earnings per share hits or misses can matter less than an executive being caught on camera at a Coldplay concert, or a tweet going out that has a typo in it that makes it seem like you aren't an AI company anymore, even though you are. Right? Like, all those things are, again, to hammer on a key word here, are material to what happens with the stock price, but they are removed from this type of information. So that to me is kind of one of those umbrella ideas that are just kind of covering this whole expectation of changes to the kind of financial reporting regime. Are we do things a lot differently in 2026 than we did in 2016 than we did in 2002, right, with Sarbanes-Oxley as a benchmark.
Right.
So I don't know if there's an answer to that or if one of those is right or wrong. Another way that I look at this information too is I think about when I was in middle school or high school, and I got a good report card, right? We were on a quarterly reporting basis in my public school education. And when I did really well, I came home with my report card open and I shared it with my parents, and I was super happy. When I didn't have a great quarter, somehow that report card was in the bottom of my backpack and maybe didn't get brought up. Might we also see some preferential choices about mandatory and voluntary reporting on a quarterly or a semi-annual basis? And how might that color, the validity of these types of choices for these businesses?
If we move from mandatory to voluntary, I think we are going to see from investors and the market this reaction of, well, if you have the opportunity to disclose, but you're not bothering to file, why not? And so whether a company is diligent and ensures that it doesn't affect their transparency and the information they disclose, even in that regard, it does present an opportunity for companies who want to kind of keep things under the rug a little bit longer. It does, present that opportunity, and rightly or wrongly, investors may just get spooked by that.
Mm-hmm. I think of it too. I always joke, if you're seeing a constant, significant disclosure in a K or Q, to speak on this topic, about a material change in accounting applications of a business, and they go from LIFO to FIFO and FIFO to LIFO every year,
right?
You're kind of making a preferential treatment about how you're presenting your financials. And I would imagine if a company is going to adopt voluntary quarterly reporting, should this move forward, they're not going to just magically not, disclose Q3 because they had a bad quarter and just hope the market is okay with it. So too with those who lean only on semi-annual reporting may not jump in Q1 and say, hey guys, look, we did so great in Q1, and then they're silent in 2 and 3. So
Right.
maybe that's the less cynical. I'm hopeful that everyone will approach these ideas with that. But let's
Yeah,
say
like
that
nobody's nobody's gonna look at it and, the company's like, we were just busy
yeah.
in Q2.
I had a vacation, and so we just didn't get it out. I'm sorry. Also, don't check our sales
Somebody was
numbers
out
at the
on
end of this.
leave.
So. That's right. So let's say that this change in requirement from mandatory quarterly filings is relaxed to only require filings on a semi-annual basis. What should publicly traded entities be thinking about in this new hypothetical at this point environment?
Like alternative ways of disclosure, or like kind of things that they need to focus on when making the decision.
Yeah. Yes, all the above.
Okay. I think, there has been some talk about using things like key performance indicators or non-GAAP metrics to disclose information, outside of a 10Q. I think the KPI idea is a good one. The non-GAAP metrics, I think, can be beneficial, but we've also seen, the SEC and the PCAOB as well push back on non-GAAP measures and say, well, this isn't providing the information that you literally have to provide.
Right.
And it could be misleading to investors because they're seeing one number thinking, oh, well, this is an accurate number that we're now going to see in the K, in the 10K. And it doesn't happen. So as far as thinking about how to disclose things, that's what I would say. As far as, bigger picture items to consider in making the decision, you have to think about your investors. What do they expect? What do you think they want? As far as voluntary, if you've had a lot of, litigation matters, if you've had a product recall, if you've had anything like that, I think you need to, take that into consideration. I mentioned before about having controls and governance. Make sure your internal controls stay up to par. Make sure your board of directors, your corporate governance folks are still engaged. And then, if there's an issue or specific impact, and this is, again, small cap firms, pre-IPO firms might be thinking about it differently than your bigger companies, your Microsofts, your Johnson & Johnson, what have you. So I think those are some things to really consider. We'll see what happens. I don't know if this is going to go through. I think we have a long time until it really gains some traction, but SEC is definitely on top of it.
I guess one of the issues with kind of those trends in public companies available for investment and that dwindling number of IPOs per year, do you think that this cost plays a significant factor? And say, we wave a magic wand tomorrow, we're mid-February of 2026, are we going to see a lot more IPOs this year? Or because there are so many other options with private equity investments and other ways to stay private, that are still beneficial to owners and founders, is it not really going to make a big difference? Or, what does your crystal ball tell you?
So I think there's two things to consider. I think first of all, Trump's drive for more IPOs is one thing. And another part of that is, this drive for IPOs that have a private-esque, they're kind of like private-esque, that, in other words, you could have retail investors really, get their money into these alternative, investment vehicles, which then, end up in an IPO. So I think that's one consideration. Another thing is I'm doing some research for another project around capital markets generally, and I've seen in my research that private companies tend to remain private a lot longer before going to an IPO than they used to. So I think that the average used to be something like 7 years. Now it's almost 16 years.
Oh, wow.
So at that
For
point,
those counting out there, that's more than double. I'll check the Excel spreadsheet, but yeah, that's a big change.
Good. You're up on your math.
I'm working on it.
But and I don't remember the time span over
Yeah.
what that change has occurred, but I think you're going to have your companies that are going through an IPO are going to be on much more solid ground.
Yeah.
To get these things going, and it's not going to have the same impact as if you're, a 3 or 4 year, in startup and you're, overvalued and you're like, hey, let's just run out and go public.
Right. Well, I think we've given our viewers and listeners a lot to think about when it comes to these issues. I'm hopeful that in the coming months we'll be able to understand as this kind of walks through that from announcement phase where we have been now with comments from the SEC commissioners and the SEC chair, as well as from President Trump, to rulemaking and potentially, those regulatory requirements to make that happen. A lot of these questions maybe will be answered or maybe continue to be open. I'm interested, Tiffany, too, in bothering you in the future about that research. So when things come together, we'll be happy to have you back to chat a bit more about some of those ideas in public markets generally, and maybe how this change is impacting there as well.
Yeah, absolutely. I mean, this may become, if this does happen, in 26, 27, I think it's going to have a pretty big impact on what the next big thing is for companies to consider in capital markets.
Of course. Well, Tiffany Rowe with Parker Poe in DC, thank you for your time today on the Immaterial Podcast.
Thank you.
As always, folks, we promise that although the Immaterial Podcast is not authoritative, we will always be authentic. We will see you next time. Thank you for tuning in.